There are a couple different negatives, I guess, heading into this year. One is that cycles that I look at tend to turn down right at the latter part of February and should be lower into about October, but it won't be a straight shot. So I'm actually expecting uh, potentially a 15 to 20% decline.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for a special interview with Mark Newton, the head of technical strategy at Fundstrat, where he works there with his partner, Tom Lee. First off, Mark, thank you so much for joining us here. I know you're in the middle of Snowmageddon back there on the East Coast, and you have a lot going on here. So thank you for making the time to do this.
Yeah, my pleasure, Adam. Great to be back with you.
All right. And folks, you can tell I am on the road. I'm at the Vancouver Resource Investment Conference. And Mark, you can be pretty sure I'm going to ask you about gold and silver and commodities at some point in this conversation, because that's the topic du jour here at this conference normally. But given
Yeah.
the just amazing price action we see going on in the precious metals right now, I'd love to get your thoughts on kind of what you think the drivers of that may be, and how many, what kind of legs you think this rally still has going forward, because it's been
Yeah.
going on for a while. Real quickly, though, let's start more at the macro level. And Mark, you've been on this program before, and if memory serves, when I interviewed you, I want to say maybe in like late October or
Mhm.
early November, you were, I think you described yourself there still as sort of, cautiously bullish, given
Mhm.
what your models were telling you at the time. And I remember you saying that you had some concerns heading into 2026 that might cause you to be less bullish going forward. But of course, you said, look, I got to wait until we actually get there to see what
Mhm.
my models are telling me. Um,
Mhm.
where are you right now as we've now, what, we're 3.5 weeks into the new year?
So I think we're setting up for much more of a choppy year than we've seen in years past. And we've had now 3 straight years of over 15% gains, over 20 for the first two, and now last year being up 17%. Heading into a midterm election year, normally that does tend to be the weakest of the 4 years that make up the presidential cycle. Um, when I'd spoken to you last, we were seeing a lot of breadth deterioration in many different sectors. That has to some extent been resolved in the last couple months since late November. We've seen a lot of sectors sort of spring to life, which is actually a positive. The one There are a couple different negatives, I guess, heading into this year. One is that cycles that I look at tend to turn down right at the latter part of February and should be lower into about October, but it won't be a straight shot. So I'm actually expecting uh, potentially a 15 to 20% decline, which starts in late February, early March, takes us down into May or June. We rally into the summer, and then we have a third quarter correction that largely marks the end of this consolidation. So I can't say that the secular longer term bull market is over. I do think it's sort of the pause that refreshes, so to speak, but I do sense that that is coming this year. And a few different reasons. One is because just the cycles are starting to suggest that that can happen. The second is that we're seeing sentiment finally start to get a little bit more optimistic on an immediate term basis. And that has less to do with really the short term geopolitical risk or sort of what's happening in the U.S. with a lot of the protests regarding immigration and this and that. It's more just about the attitudes towards the market have gotten a lot more optimistic, and that's something I was waiting to see. It really was never present last year. We went from rampant pessimism back in April to a little bit less bullish or less bearish throughout the year, but not really ever speculative and really optimistic. And we're starting to get to levels that are near that level. We're not there yet, but on a rally to 7,200, which I expect into late February, I think we'll get there. The other reason is that technology certainly has been sort of a shell of its former self. We're seeing, large cap technology, the Mag 7, many of these stocks have gone sideways for about 6 months. Noticeable slowdown in momentum, certainly sort of a changing of the guard. When you see, sectors like consumer staples are beating technology over the first few months, first few weeks of the year by about 300 basis points, it makes you pay attention that we're definitely seeing some sector rotation that it's important to pay attention to. And this is more than just mean reversion, I think, where the worst sectors of the prior year tend to outperform and vice versa. That can happen as you enter a new year, but I think that tech has gotten very overbought, and I think that this is going to be the year where we do see some weakness in technology. So the good news is that I don't think it's going to be an earnings-led decline. I think it's going to be largely just concentrated in large cap technology, maybe as interest rates start to push higher in the long end. But we have seen some great broadening out in many different sectors that have not worked in quite a while. And that's, I think, the bigger picture good news for long-term investors is that weakness this year should be buyable, but I sense it's going to be a lot trickier than people expect, and that's for bulls and bears alike.
Okay, great setup here. Let me ask you this. So you don't expect it to be a general earnings-led decline. And sorry, folks, if you can hear that noise outside. There's a like a seaplane landing runway right near where I'm staying here in the hotel. So you might hear that a little bit more while we're talking. Um, but so you don't expect this to be kind of a broad-based earnings-led decline. Does that mean that yes, the big tech you expect not to perform well, and because it's such a big part of the indices, it can pull down the S&P, it can pull down the Nasdaq. But if you are a maybe more nimble, active trader and you are, rotating into other sectors, you may actually be able to engineer a pretty good year for yourself, just as long as you're not in the parts of the market like tech that are getting dragged down.
I certainly sense that investors can outperform the benchmarks because if Nvidia and Apple account for 15% of the S&P and they're starting to go lower, this is going to be a great year. Not a great year. I think the portfolio managers will finally be able to probably show some outperformance over the benchmarks. In recent years, that's been very difficult as Nvidia has garnered more and more percentage of the S&P and Apple, and they've been pushing higher. And portfolio managers that don't own these stocks have had a real difficulty keeping up and showing outperformance. And this will be a year where I think if you own sectors like energy, materials, you can certainly even parts of industrials and transportation are doing very, very well. So I think, there's an interesting bifurcation where, historically we've seen great outperformance from the AI generators. And I think to some extent, this is going to push into more of the AI beneficiaries that probably do a little bit better this year, whereas the large cap tech stocks just need to pull back a little bit.
Mhm. When you say AI beneficiaries, do you mean other subsets of the AI market that are now stepping to the forefront? Or do you mean kind of general corporate America just finally benefiting from AI?
Yeah, it's interesting. I mean, we heard reports over in Davos that many governments are now starting to take an interest in AI across the globe, and I think many different areas of the market probably can start to benefit from that. And in the last couple of years, we've seen mostly those companies that have developed and started AI show the biggest gains, and now that's starting to show evidence of spreading. So um, I don't have the perfect words to describe it. I just think the market's getting a little bit more broad-based, and I think that in general is a good sign. But uh, a few warning signs on the horizon that I see that once we see evidence of technical trends starting to break down, and we haven't seen that yet, that would be a sign to probably adopt a little bit more of a defensive uh, stance, I think, between the traditionally bearish time, which is really May through October. And I think that probably starts earlier this year, probably in March or late
Okay.
February.
So I'm going to make an analogy here, and it might be a bad one, so please feel free to correct me. But um, made it in the past year where so imagine you have a basketball team made up of, five 90-pound weaklings and LeBron James, right? That team is still may able to win a lot of basketball games because of how dominant LeBron is. But it's not a very healthy bench, if you will, or a healthy team. Um, So we may be entering the period where maybe LeBron is stumbling a bit, maybe he's got an ankle injury or something, but we start replacing these weaklings with some better players. That's probably better off for the overall team's health, but the team may actually have a worse season this year as, LeBron is coming down and it's making the changes on the bench. Do you sort of see it like that, where in other words, like this broadening might be good long term for the market, but we may
Yes,
have an underperformance year because the star player is stumbling a little bit?
I think that's exactly right, Adam. I think when you look across the globe and you see many different stock indices at new all-time highs across Europe, certainly what's happening in Japan is extraordinary. Evidence of emerging markets starting to break out, and you see the EEM, the emerging markets ETF, has broken out to the largest level in over a decade. I think that's very constructive at a time when the dollar has started to turn down. Um, Meanwhile, we have the Dow Jones Transportation Average also that has recently broke out, along with the small cap IWM. Certainly not a time when normally, you would say, "Well, it's time to really sell stocks," and I think it still is, from a short-term timing perspective. I think it is still quite premature by probably about a month. But I don't. I think you really have to watch carefully the degree to which technology plays comeback after earnings, which kick off this week. And I think if you have a sort of a slow, lackluster bounce between now and 7,200, and that would raise a few alarm bells, because I also suspect that more and more people would get on board the rally. So it's more about sentiment and cycles and just keeping a really close eye on breadth. And I think those are key. But for me, of course, as a longer term trend following technician, trends matter more than anything. And attempts to try to sell markets when they're in uptrends generally does not work out. People rarely can pick the top and the bottom as easily as you might expect. And so easier to pick bottoms during time of fear than tops during times of complacency. But we shall see what happens. I suspect that if some of the cycles that I look at are accurate, then March should be an interesting time for the market.
Okay. So first off, we're going to talk about the difficulty of picking tops when we talk about gold and silver right now, because they're just vertical at this point in time. So
Yeah.
vertical don't last forever, and so there's a big debate going on saying when is it time to start selling. But first off, let me both uh, thank you and curse you, if you will. So you brought up something I bring up a lot, which is just statistically, right? The markets had three near 20% years, as you said earlier, right? Back to back to back, which is rare for the markets. So to expect a fourth year of similar outperformance, just forget about fundamentals, technicals, et cetera. Just statistically, it's very, very rare, right? So I'm glad that you brought that up, which is to say, hey, look, we just need to expect that there's going to be some change at some point in time. Now, the reason why I'm cursing you is because, I get as I don't screen people for their point of view. I just bring on people who are intelligent and have a data-driven explanation for why they develop the market macro outlooks they have. That said, I would say the majority of people that I've interviewed over the past year have been, somewhat more pessimistic than optimistic. And so I get kind of painted with this brush that says, Adam, you only bring on bears, right? So I was hoping with you coming on, Mark, especially with your partner there at Fundstrat, okay, well, we're going to have a guy who's probably going to deliver somewhat of a bullish case. Now, Mark, I know that you, more than anything, just follow the technicals. So you're going to tell me what your technicals are saying. But yeah, people are going to say, all right, Adam, there's one more bear in the mix here. But you're just calling it as you see it.
So to be clear, Tom Lee and I have, of course, a different methodology and also a different time frame for how we look at things. I write a daily market report and do daily videos of the market, which covers all different asset classes. And I tend to be a little bit more tactical and shorter term than
Yeah.
Tom. So when he has an intermediate term bullish case on AI going on for years, I respect that for a lot of the right reasons. Even Tom has joined me in being a little bit more cautious for the first half of this year.
Mhm.
Um, and so, it's less about, it all depends on your time frame. And right now, look, the very short term is still bullish, and the intermediate term, meaning probably if you were to go out 5 years, I think we'll probably still be okay. But it's more about the time for between now and October, which I think is going to be very choppy and might give a little bit of a surprise to the downside, which some would argue is much needed. To your earlier point, I mean, there have been several times in history when we've had, multiple years of rising prices, and that doesn't mean you just rush in and sell because we've been up 3 years in a row. You have to always look for the warning signs, and for me, it's always about breadth deterioration, and or some leading sectors like tech that are starting to roll over cycles and really sentiment. And a few of those things are now in place this year, which makes me think it's going to be a more challenging year for investors, but also something where if you were to look to buy dips into the fall, I think it's going to be quite rewarding actually between late 2026 and 2028.
Okay, so if I took good notes, you said, hey, this is going to be a choppy year, meaning it's going to be more volatile than folks maybe have gotten accustomed to over the past couple of years. Um, and as you said, in the immediate term, like next month or so, you wouldn't be surprised to see an all-time high on the S&P,
Right.
right? So you're not predicting total calamity, and then you said there'll be some sort of correction. I don't know if I picked up sort of what magnitude you're talking about. I didn't get a sense that it's super dramatic. Then a rally, maybe mid-year, and then maybe a more pronounced slowing down at the end of the year. And I think you said something like, wouldn't surprise you to see the market down 15-20% by the time the year ends. Did I catch it all right?
I think that's right. If I could possibly share my screen, I will
Absolutely.
sort of share with you my, really what I expect from this year, and that I think we probably have the potential to get between 5,600 and 5,900 sometime in October from levels that are probably right around 7,200 on the upside. So ideally, this would work in sort of a three-wave type fashion where you initially have the strong sell-off into late spring, early summer, you rally into the summer, and then you pull back pretty sharply in Q3.
Okay. And
Uh,
sorry, I'm just looking closely here at the chart. And I know this is meant to be sort of instructive and not exact numbers, but you're looking at a correction of about 1,000 points of the S&P pre-summer, correct?
that's right. Yeah.
Okay. So,
Well,
so I mean, for
let's
some
say
people, it's not
I
catastrophic,
think
but that would sting.
I think I don't think that it probably will not happen before the summer, but I think it will certainly show signs of having started before the summer. I think the majority of the worst part of it might come between August and October, and I
Mhm.
think that's something to, and that's due to the cycles that I'm looking at for Apple and Nvidia, and both of those have a pretty rough late summer, early fall. But when you look at the actual cycle, this is one that I've used for years, and it had been pretty accurate in recent years, and it did show, the potential for, a rally into probably February, March, a dip, and then the period from late 2026 into 2028. That's one cycle. The other is just based on the 41-month cycle of that was created by Edward Dewey that measures, you know, it's one of the best longer term cycles for the stock market that I know. It's about 180 weeks or about 3.5 years in general. And it pinpointed the peaks in 2000, 2007, the bottoms in '09. It was very accurate throughout the mid 70s. And so it does show that this is a year of weakness for the market. These pink lines represent amplitude, not magnitude. It doesn't mean we
Yeah.
have to go all the way back down to the lows, but it is something that I think is important. And so, um, my sector wise, I've dropped my technology from an overweight down to a neutral. And my overweights for this year are industrials, energy, financials, and utilities.
Hmm.
And, meanwhile, I think a lot of the sectors are probably going to be pretty neutral. These are the concerns that I had heading into this year from last year. And some of these were partially reversed, that momentum and breadth have been waning since July. So those have improved. The broader market, number point two, has actually started to show good strength. And so when you say all-time highs, the Dow's already at all-time highs. The equated S&P is, and the Russell, and most of Europe and the transports, and there's a lot of really good things happening, but it's also being noticed by many people. And so, much of this is going to do with cycles and sentiment, I think, as to why, you know, the market starts to turn down.
Sure. So, Mark, thank you. Those charts are very helpful. And the chart you showed of uh, your current outlook for the different segments, very useful. I'm curious, given a year that you expect to be volatile and, could end in a up to 20% correction, um, is your sort of approach, okay, so ride out that year in these sectors that are likely to perform better. Um, I mean, I'm guessing yes, that's a big part of it, but also is there any de-risking in there, right? Like, hey, you might want to take, your portfolio down from 100% long to 80% long and then put it in these, better sectors.
Yeah, look, those are great questions. They really all have to do with one's own risk tolerance and time horizon for the market. And if you have a
Mhm.
time horizon that goes out till 2028, then you might decide to ride it out and just hedge using puts or VIX calls or maybe taking some technology off the table, emphasizing a lot more of the safety type sectors like consumer staples that are starting to show more strength.
Mhm.
Um, I do look at the market every day, and when I start to see trends break, then I will suggest that it's probably a good time to raise some cash to potentially put some money into treasuries. I think that between probably February and July, we do get some rally in the treasury market where we see yields start to pull back again. And so I think that there are some opportunities. And to your point on the metals, we can speak about that in a minute, but that has been, of course, just a phenomenal area. Commodities have started to come back with a vengeance, and I think that is very interesting during a time of the year when inflation largely has been, showing evidence of weakening. And
Right.
so it's interesting that commodities can rally if inflation is not really going anywhere, right? So the parts of commodities that are doing well, I tend to think that it is right to be very much diversified. The problem and error that investors made in recent years is really being too overweight technology, just
Mhm.
because of you have some QQQ or some SPY and you want to own Apple, and before long you look at your portfolio and it's about 80% technology. And most
Yeah.
people have been a little frustrated in recent months to say,
And sorry to interrupt, but you may own other, ETFs, funds that aren't marketed as tech funds that still have a ton of tech in them.
yeah, 100%. And I think that's the real key, is to know what you own. And so diversifying into areas that have some Coca-Cola or McDonald's, or, areas that have exposure to emerging markets, or have more a heavier exposure to commodities, or have exposure to emerging markets, I think makes a world of sense in this year, where the dollar to me looks like it's set to pull back to new lows under last year's lows, which likely happens between now and the summer. So if what I'm thinking is right, we're going to see a massive U.S. dollar devaluation, which it should be has already gotten underway in my view, and I've written about that in recent notes.
Okay, well then that's a great segue into the metals and commodity part of this discussion. So I don't remember if your slide there of the different sectors had commodities on it, but it sounds like you feel pretty bullish about commodities for this year.
Well, look, I basically sympathize with your point about most of the metals being in very late stages of their rallies, but you do have movement in silver for anybody that's a technician or takes the time to pull up long-term charts. I mean, this is has been one of the more bullish longer term base breakouts that we've seen in a long, long time. I mean, these peaks in silver last occurred near the Hunt brothers squeeze, and the movement just you know in the last 24 hours is being reminiscent. Silver's up 11% today, right? So
Yeah.
so we have not
And
only
that's
massive.
after what, almost quadrupling last year.
Yeah, well, that's the thing. You put this into perspective and you see that it made peaks back in 79, 80, and then peaks back, in 2011. And now that level has been exceeded. And technically, that can allow for a real acceleration. So I wrote this back in November, December, heading into the year, and my target for silver was 100, and now we're clearly above that. Um, the cycles are in the latter part of their uh, they're getting very stretched. And I think that, for me, I thought gold probably would get to, 5,000 and then pull back, and we're already above 5,000. So,
Yeah, so
my
we
thinking
just
is,
to interrupt, but we finally really cracked 5,000 last night, which was Sunday night in the futures market. It's now already 5,100. Like silver, it's just not looking back.
so I guess the issue that I have with the metals is twofold. And one is that, if you own physical silver, I mean, it's very difficult to unload it. The dealers are not taking it at current prices. There's some really interesting dynamics going on where it's just gotten really, really high. Sentiment is everybody around the world is now noticing that precious metals are moving, and they haven't noticed that for 2, 3 years. You and I talked about it in what, September, I think,
Mhm.
and or even prior to that, back in the spring, and that both of us were very bullish on the metals, and it was right to be long. And now it's a very poor risk reward in my view at current levels. But technically, I'm not able to sell it just yet. Um,
Because the
I
trend
think
hasn't started to show signs of breaking down.
it's not. No, of course not. It needs to before you really turn negative. But it's one of those things where the party's getting late and you don't want to be the last one at the punch bowl. And so, is
Right.
it right to stay at the party? Well, that depends on your risk reward. I do sense that we have another week or two. I am looking for a rally into early February and then a pretty good correction. Uh, However, you really need to do a lot of damage to think that anything that's moving parabolically, when you see your first sell off, that doesn't mean the peak's in and it's time to just
Right.
short. And it takes usually a number of different attempts at hitting highs before you roll over. So I do sense that we're probably a few weeks away from that. And February is probably the month when that happens and starts to sell off. I think that will provide opportunities on a 10, 15, 20% pullback for those that are traders. For those that are longer term investors, I just sense that you're very late to the game. And unfortunately, it's been a nice 3 year run, and now it's going parabolic. And usually that means it's a time to consider keeping your stops very tight. You never want to give back gains when something that's parabolic starts to turn, because sometimes it can really erase a lot of those profits. And just very important to keep a ruler out handy for those that are not technicians, and follow trends and certainly obey them when they start to be broken.
Yeah, so Mark, I'm at a conference right now where it's really interesting. It's kind of like, finally their year, right? I mean, I've been to this conference before. There's
Yeah.
at least two times the number of people here versus the last time I was here.
Yeah.
Uh, and it's funny because the old veterans, the guys that have been in this industry for 40, 50 years are saying, hey, like we've kind of seen this movie before. This is, in their opinion, it's gone into bubble territory. And by the way, these guys are, big precious metals champions, have been,
Yeah.
have a lot of exposure. But they're basically saying, look, when you get to the mania stage like this and the price action goes vertical, these almost never resolve by going sideways. They resolve in pretty brutal, price corrections.
Right.
And they're sort of saying like, look, if you're feeling elated by the gains that you've gotten in this metal, like congratulations, you kind of won the bet you made. But don't be an idiot and be naked along here as we're getting to the end blow off stage, and put yourself at risk of having your great gains vaporize if this follows this similar price action of other big mania spikes we've seen like this in the market. Now then you have a younger crew of guys here, who are like, you guys don't get it. It's different this time, right? Which of course the most dangerous words in investing. But it's a global monetary reset that's going on. The debt is now out of control. We've just passed the point where the U.S. debt service is greater than the defense budget, and it's a different world. And you'd be an idiot to jump off this. You know, out of this trade right now because it's got several legs ahead of it here. So where I'm going with this, feel free to comment on any of that. But where I'm going with this is you mentioned stops. Like for the average investor who maybe got in a year ago and is like, oh my God, my gold is, more than doubled and my silver has quadrupled here. um, maybe I should start protecting this in some shape or form. I don't want to exit the trade entirely. Do you have any particular preferred way to sort of play this, knowing this isn't personal finance, financial advice for any individual watching this? You know, is it more stops? Is it more just selling out and going to cash? Is it more using puts? You know, some options, right? What would you think?
Yeah, there's a lot to unpack there. I
Uh,
would simply say that it's always better to have a basic understanding of technical analysis and how charts can help you to manage risk versus listening to those who, are already dug in either bullish or bearish and might have their own ideas as to why they're working. And I can come up with a dozen reasons why, this should be a great year for precious metals. I just don't know that we have much gains probably after the first half of this year.
mhm,
I think interest rates are due to make a sort of a 6-year bottom. At least the treasuries are likely going to have a cycle that shows a peak in treasuries probably by the middle part of this year that is overdue, which means that rates very well could go higher over the next couple of years. Historically, that's not been great for precious metals, and you really want to watch as real yields start to creep up. And so I just worry that, I think that you never want to get too enthusiastic about your reasoning where you're avoiding watching actual price action itself. And right now, it's as people that are bullish see prices rise, they become more and more emboldened that, wow, this
mhm.
is the right call. And they completely have the blinders on as to why, when to get out. And if it's silver's up 20-30% in about a week, I mean, you sort of need to understand where you're going to exit and take profits, not just sit there. Um, the second point, and all this is always about respecting one's own methodology. And again, that's so much of this conversation is just different people have different time frames. And for gold, for example, even just since last August, we've been from what 3,200 to 5,000 very quickly. Any sort of minor pullback until it breaks the larger trend is probably still going to be okay to own. It's really when you start to break trends and even if you can't keep track of that, I would say watch when silver or gold start to make a new multi-week low. In other words, we're going up and up and up. Well, when does that stall and start to roll over? If you want to be short term, wait for it to make a new, say, 3-day low. At a minimum, that will be very helpful. And I mean 3-day low on a closing basis. So right now we're going straight up. I never advocate people sell usually into strength. But when we start to roll over, that's the time when the buying has dried up and the sellers take over and things can get very volatile on the downside. So for very short-term traders, watch for a 3-day low. For intermediate term traders, use trend lines and or watch for a new 3-week low. And normally that can help you to, keep a lot more of your profits than trying to understand where we are in the cycle and saying, well, I'm just going to ignore the weakness because this is the new age. And yeah, I do sense that, the Fed obviously is in a challenging spot this year and is going to be under a lot of pressure from the administration. And there's no easy answer as to who is going to be the new chairman. And obviously, it probably is going to be somebody that's at least as dovish and probably is going to be more dovish than Powell. And so that's probably going to be good news. That means that rates probably will come down another 2 times this year. Normally, as rates come down, that's good for the metals. But the debt is a bigger issue. If tariffs were to be reversed by the Supreme Court, and we know that, you know, not taking any political stance at all, but certainly companies have felt, a certain sense of uncertainty, to say the least, when they don't know what their cash flows are going to be or where they're investing or what tariffs, what effect they could have. The tariffs have been a negative for most companies, but they've actually been quite a bit of a positive for when you look at the trade balance. And we've seen that have been cut in half down to 29 billion as of last month. That's really an impressive reversal and about
Mhm.
face, which means that the tariffs have been working quite well. So if this were going to be rolled back, how does that work in terms of compensating the countries that have paid us this money? And furthermore, we're not going to be addressing the spending anytime soon, and that's just going to lead to more and more, you know, payments that we're making where our interest payments are greater than we're spending on defense, and that's going to be eventually that's going to be a problem that is going to come to the forefront that it's going to be an issue. So my biggest thing is watch sentiment for the metals and try to find as many different sources of sentiment as you can. The CFTC positioning, or just talk to people around you. Everybody all of a sudden is starting to talk about metals. That's one sign that obviously is very unusual and it's come out of nowhere. Uh, but you want to see it actually in the price action. You want to see prices reverse, and that's the biggest thing. It doesn't matter what sentiment is. If prices continue to go up, then it's fine to be long. I just view it as a sort of a poor intermediate term risk reward given the parabolic state. And I personally am looking for exits. Last time we spoke, I said that silver and gold were one of my biggest longs for 2025. And then I told you in the last conference call, I think we're going to peak out in October. Well, we did peak out. I got rid of a lot of my gold and silver. We had a pretty sharp correction, but now it's right back up and even stronger. And I violated one of my own rules, is that the intermediate term trends weren't broken at all on the metals. It was a short, sharp 15, 20% correction. So it suited a lot of people that wanted to find a peak and short or get out. But yeah, for the longer term investor, you need to see evidence of these longer term trends being broken before you really address whether it's right to be in or out.
Okay. Let me ask you a more fundamental and not technical question here on precious metals. So one of the things that's been talked about a fair amount here at this conference is, and this is sort of a segue to your point about bonds, is you're starting to see more like Wall Street firms say, you know what, we had this 40 plus year bond bull market. We might be in a different regime going forward with bonds. And so you may want to look at the traditional 60-40 allocation and, look at that 40% that used to be in bonds and maybe take, some chunk of that and put that into gold instead of bonds. And number of people here saying that's the next big wave that's going to carry this gold bull market higher as that capital, because the gold market is pretty tiny compared to the bond market, so it wouldn't take too many percentage points of bond capital to flow in here to still give a lot more octane to what's going on here. Just given your proximity to what Wall Street is doing, is that a potential macro trend factor that you're paying any attention to?
If one is not invested in gold already on an intermediate term basis, I would not suggest that that's the right move to make, at least for me. I don't think that it's an attractive risk reward for the year for metals. But I think that right now prices are going up. It's fashionable short term, but treasuries are going to be a better risk reward, I think, for the next 6 months and thereafter. If gold, let's say let's say yields get down to 385 on the 10-year, and all of a sudden, precious metals have corrected 20 to 25%. Well, maybe I would consider it then. I certainly do think that this year, more than ever, is a good year for diversification, but I can't simply say that gold is probably the better area. In general, commodities would make more sense as a bucket because I think crude is likely going to be ending its 3-year bear market sometime in the next month. And I do sense that prices go pretty sharply lower from here. But I also think that energy is going to outperform this year. I sense that crude is going to have a pretty good lift between probably March and July.
All right, I'm glad you mentioned that. I've been increasingly talking about the prospects of the oil and gas industry with a lot of the experts on this channel. In fact, the video right before this one, Mark, was with Rick Rule. I don't know if you know who he is, but he's a very well-known natural resources investor, and basically said, look, I think the oil and gas sector is as attractive as I've seen it in my career. Now, he's not talking about a quarterly outlook. He's talking about at some point over the next 1 to 3 years, he
Yeah,
thinks that thing might swing back into boom because it's been in bust for a good while, and
yeah.
you can get in at attractive prices now and get paid to wait because a lot of these companies pay pretty generous dividends. So it sounds like you're seeing corroborative uh, data, using your very technical driven methodology here.
I do. Some of the cycles that I look at for crude oil do tend to bottom really in the next couple months and start to turn higher. I think that this recent little bounce is more Iran related and probably a little bit of a head fake. I do sense that crude probably gets to 65 but then it should have a pretty big pullback, which might start in maybe mid-February and start to go lower, and that should be really the final washout for crude oil, in my view. And then at that thereafter, I would agree with that. I think that anything with regards to Venezuela, we need to get prices materially higher to make that attractive at all to even consider if the U.S. were to attempt to go in and extract or get Venezuela up to, let's say, 2 or 3 million barrels a day again, from under a million now, right? So I think that's is that correct? Or I'm thinking of yeah. In general, I think their total output has just been reduced substantially, and it would be so costly. I think the CEO of Exxon said it right that it's really unattractive at this point. So for AI, also we know that there's going to be a need for fossil fuels, and so I think that Saudi Arabia and the U.S. have probably cut a deal a few months ago to keep prices low, but I don't sense that's going to last forever. And I
Forever.
sense that probably in the next quarter that we probably start to bottom and start to move up.
Well, what I always like, given my position of being able to talk to lots of different people, is I like when I hear different analysts using different methodologies come to similar conclusions, right? That's a pattern that when I see it usually says there's probably something there, right? Because people have
Yep.
different lenses, they're using different approaches, yet they're you know process brings them to the same point of view. Now, Rick is very much, he's very much he's not a technical guy like you
Yep.
are. He's much more macro, but he's very close to the production side of things. I mean, he
Yep.
knows all the people that own the wells or own the mines or whatever. And, a big part of his outlook is one that global demand is going to keep growing for a whole bunch of reasons, but
Yep.
in the commodity industry, in oil in particular, the cure for low prices is low prices, right? Prices get low enough for long enough, people just stop exploring and developing because it's not profitable to do so, and then supply gets tight as a result of that, and that shoots prices up, and then the boom cycle starts.
Yeah, and so I just look at it more about cycles and trends, and short-term trends certainly have turned a little bit more bullish for crude, but I sense that near term we might push into the mid 60s, and then we're going to have a pretty big sell-off for reasons that I probably don't understand the fundamental reasons for, but I think that will provide a pretty good buying opportunity for crude. So
Okay, well, it looks like crude is broken out from at least the trend line you have drawn here. If it gets up to the mid 60s and then has a correction, would you expect it to go back down to that trend line, or is the trend line now changing because of the break?
yeah, no, I think it probably does. I mean, it's funny because I look at a combination of like Elliott wave and cycles, and most of the stuff for crude does show just over the last couple decades that we're due to start a pretty big move up, and this lasts into the summer, but we'll see if that lasts or not. Energy itself, many different parts of energy have been working very well, and OIH, XLE, of course, the exploration and production have been a big laggard. I think there's probably a little bit of a bounce here, but then that's going to be a little bit weaker. So it'll be, yeah, it's an interesting sector for sure, but different parts of commodities are starting to perk up, and that's definitely interesting to me.
All right. Well, Mark, if your schedule allows, love to have you back on in Q2 and, call an audible for us on what you see going on. But if it turns out that a lot of the things you've talked about here kind of come to pass, it could be an interesting time for, the investor, the type that watches this channel to, maybe start to really take some action on some of these things. Because it sounds like if we get that drawdown in oil after hitting the mid 60s, that could be a good time to really get in before the pop you expect is going to happen. Um, it might be a good time, I guess now you're saying maybe to buy some bonds and by midsummer might be time to get out of them if things are bottoming then. But
Yeah,
just
the biggest thing that I see is the dollar really having started to accelerate dramatically to the downside.
to the
And
downside.
so this has already broken down to the lowest level almost since last fall. And so that one can get long the euro and get long pound sterling. The yen is going to take some time. That also eventually should rally a little bit. But what's happening with Takaichi, I sense the dollar yen is going to be quite weak between probably the spring and the end of the year. So any sort of pullback you see in dollar yen, if we get down to 147, 150, should be a chance to really get short the yen for a chance for that to probably get to 175 or even 200. So I sense that, Japan has been through just a relentless wave of, deflation for so long. They're willing to tolerate inflation, and to the extent that, the JGBs have been, you know, showing such volatility that Scott Bessent, placed a call over to Japan. I think that they're going to try to. We'll see what happens, but I sense that we're going to start to see rate hikes, and at some point we're going to see a. I think this year is still going to be very weak for the yen, so that's interesting. It probably means their stock market, it might correct during the same time as ours does, but it should be a great time to own Japan for the years to come at all-time highs.
Okay. All right. Well, look, I know you got to get off in just a minute
Yep.
here. So real quick, you showed some of the cycles that you look at. I'm just curious, I interviewed Michael Howe recently. Not sure if you're familiar with him, but he's liquidity is his big thing. He's a former Salomon Brothers guy. He's
Yep.
been, following these liquidity models for decades and decades. And from the years I've been interviewing him, his calls have been pretty good, and they're largely based on what's happening with liquidity flow. So, for example, he was, I think, the first guy I know to really go put his neck out and go long in October of 2022. And it was largely because, his multi-year global liquidity cycle had bottomed and was starting up again. And, with a lot of people I interview here, sometimes I do just say, look, is it really at the end of the day just all about liquidity? Because when the tide is rising, all boats kind of go up with it. So his model, he thinks the current multi-year cycle peaked out in Q4. So
Oh,
we just started to peak, and it's, we probably have a multi-year down cycle against it. And the cycles are the duration is variable because it depends on the speed of the decline. Um, but he's basically kind of like you saying, hey, we're going to start having more headwinds this year. It's going to be a more volatile
yeah.
year because of liquidity. Do you look at liquidity at all in do you take that into account at all in your soup of data that you look at?
Yeah, no, I really do. There's so much information to look at. It's not part of my personal toolbox. If I can just look at sector rotation and trends and sentiment and seasonality and cycles, they tend to provide a lot of the shorter term, avenues that really can help investors stay on the right side of trends. I mean, liquidity is a longer term type thing. In my view, it would probably take a longer time to make heads or tails as to if you take a stance based on liquidity, it might not materialize right away, but it
Right.
certainly for an intermediate term would be important. I would think that, cutting back on QT, could produce the opposite in the short run, but we'll see. And if they ratchet rates down another couple of times, I think that would be helpful. But we still have an affordability problem, of course, in the U.S. and
Mhm.
housing where it is, and mortgage rates they've come down to 6%, but they're still roughly double what they were a couple of years ago. So yeah, we'll see how that all shakes out.
All right. Well, Mark, I can't thank you enough, especially for squeezing this in, everything that's going on in your busy
Of
schedule.
course, yeah, my pleasure. We got hit pretty hard with about 15 inches of snow out east, but everything's going to be just fine. So,
All right.
bottom line is stay the course. Depending on your risk tolerance, stay the course. But I expect eventually the S&P for the year might get to 7,300, and 7,200 might be possible over the next month. But I'm after that. I think it's really going to be a choppy time for spring and really Q3, and you want to buy dips into that in October.
Okay. So, again, I'd love to have you on quarterly at least, just to kind of provide
Great.
you a chance to provide audible calls and all that in case other things are changing. For folks that would really have really appreciated this and would like to follow you and your work between the next time you come on this channel, Mark, where should they go?
So I would either suggest going to fundstrat.com, Fundstrat, or FS Insight. We have a product for both retail and also institutions. Myself, you can follow me on X on Mark Newton CMT, and happy to provide your viewers with maybe a link that they can click on or a QR code that might be that can bring you to that. I'll provide you with that after the interview.
Great. So, Mark, as usual, when I edit this, I'll put up the links to those URLs into your X handle.
Yeah.
I'll also put the links in the description below the video, folks, and also down there, Mark, if you send me that code or that link, special link itself, we'll put it there too, so folks can get to all those places with just one click. Mark, it's always such a pleasure. Folks, please do me a favor. Please let Mark know how much you appreciate him coming on. by hitting the like button and then clicking the subscribe button below, as well as that little bell
Yep.
icon right next to it. And if you want to get some help in taking some action in your portfolio based on anything that Mark and I discussed here, if you don't already have a good financial advisor advising you on that, feel free to talk to one of the ones that Thoughtful Money endorses for free. To do that, just go to thoughtfulmoney.com, fill out the short form there. Mark, really hope you get home okay today. Strap on those snowshoes and get some hot chocolate.
Thank you, Adam. Happy New Year to everybody, and look forward to talking to you again soon. Take care.
All right, thanks so much. And everybody else, thanks so much for watching.
In the bust, most assets are going to go down other than treasuries. But so gold will correct. If 4,000 were the high, and it may not be, could just as easily be 4,500, but if 4,000 is a high, you could be back to 3,000 or below in the bust. People want a target in the bust. I go, we don't even know what the high is on the way up. So, but it'll get hit by, 30% or more probably. Silver, if my target on silver is 75, if we correct from 75, that is more volatile, so that could go down, back into the below 30 or back into the 20s. So they're not going to be straight lines. In both cases, I think this is important. In both cases, in the post-bust era, which is 2027 and beyond, I believe you'll see gold probably in the early 2030s, and silver, same time frame, gold to 20,000 and silver to 500. So
the outlook suggests that during a coming bust, nearly all assets except treasuries could fall sharply. If gold peaks around $4,000 to $4,500, it could correct by 30% or more, potentially dropping back near $3,000. But Goldman Sachs says gold could hit $5,000 under scenarios like political threats to Fed independence. Meanwhile, silver, being more volatile, might fall even harder. If it reaches $75, a correction could send it back below $30. These moves won't be in straight lines, but in the long run, especially from 2027 onward, the forecast is extremely bullish. Gold could reach $20,000 and silver around $500 by the early 2030s. David Hunter, a precious metal expert, points out that gold recently broke out of its consolidation range around $3,300 to $3,400, pushing to new highs, with targets now raised to $4,000 and possibly higher. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. They say that would trigger a flight from traditional safe havens, assets people run to when markets get shaky, traditionally, the U.S. dollar. Forecast already predicts gold reaching $3,700 by the end of 2025 and $4,000 by mid-2026. The result of their expectation that central banks will continue their current gold buying spree. On the other hand, silver has been even stronger, up nearly 50% since April compared to gold's 21%. David mentions key drivers include a weaker dollar, falling interest rates, geopolitical tensions, and heavy central bank buying, all reinforced by strong momentum now attracting institutions. The dollar, down from 110 to 97, could drop further toward 82 in steep steps. With the Fed just beginning a rate-cutting cycle that could bring rates near zero over the next 18 months, both gold and silver still have significant room to run despite cautious sentiment in markets. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article.
absolutely, and I do say gold was in a consolidation from basically April till recently, and it broke out, from 3,300, 3,400, broke out here, and we're at new highs again. I raised my target to 4,000 last year, or not last year, I think a couple letters ago, and I'm not going to be surprised if that proves to be low, more conservative. So I'm very bullish gold here. I'm even more bullish silver. Silver's had a great run. It's up. I just did the numbers yesterday. From April to now, gold is up 21%, I think, and silver's up 49%. So it's quietly, people haven't really noticed, but it's quietly outperforming gold as it does in a bull market. So I think silver has a long ways to go. Gold probably has a good ways to go too. So I think the weaker dollar is certainly part of that story. Lower interest rates is certainly part of that story. You know, global unrest and global uncertainty is certainly part of that story. And the central banks around the world gobbling up gold is certainly a piece of it too. So, and then the final piece, which people always underestimate, is the power of the momentum. You know, it's all of a sudden the institutions are starting to notice gold, even though it's been running for years. You know, because it's got that momentum now, they're starting to say, hey, we have to have a piece of gold in our portfolios. Not at all. I mean, the dollar's fallen from, you know, basically 110 to 97 in a matter of a year, probably, or less. And I think it's my target is 82. That's far below here. It'll happen in some pretty steep steps. So the first step down in, you know, the mid 90s, and then you consolidated here. I think the next step down takes you down through 90, and then the third step down to 82. So I'm not surprised at all. You have to go through consolidations when you have such a big decline. It then goes the other way for a little while. You have to convince some of the people that were jumping on the bandwagon, but not with conviction, that whoops, this thing's going the other way. So I think we've just pretty much gone through that consolidation, and now we're beginning the next leg down, and I think it could happen pretty fast. Well, think about that. I think that tells you the sentiment that's on the street. Everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit, right? And so what we've had here, we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from, you know, 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months, that's what you're looking at, you know, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run. Silver's got a ways to run. The stock market's got a ways to run. And yet everybody's getting nervous here rather than bullish.
A few years ago, David called for a major market melt-up and has steadily raised his targets as conditions improved. His S&P 500 target has climbed from 6,000 to 8,700, with Nasdaq at 30,000 and Dow at 60,000. He views this as the tail end of a long bull cycle that began in 1982, likely topping out soon, but still with strong upside left. Despite a slowing economy, falling interest rates and steady earnings are fueling gains. Interestingly, retail investors have stayed confident and bought dips, while institutions were more cautious and even bearish, only now starting to turn more aggressive as they see the market's momentum. Let's look back at the interview.
Probably 3 or 4 years ago, because I was calling for this melt up, and you know, I get accused of raising my targets constantly. I go, that's what you do. As the evidence proves it's got more, you know, there's more things saying it should go higher, you raise your target. So, you know, I started out at 6,000, or even before that at 4,000, but I've raised it to, you know, 7,000 and 7,500 and 8,000, now 8,700 on the S&P. And same thing, I've raised my gold target a few times. But it's the case that this thing is a big historic bull market. And you just gotta stay with it. I'm sorry, I lost my train of thought of what you would. Oh, we were talking about the VIX. Several years ago, I said the VIX could go to 10, and that was when it was in the 20s. And I said if we've got, and that was when I thought the market might go to 4,800 or 5,000. I still would say that the low on the VIX, I think, is down just below 10. I think that's probably where we're headed again. So everybody gets worried when it gets down at 14, 15. I go, it can keep going, and there's no magic at 10. If it wants to go lower, it's really, it's a trading vehicle. There are times when it the market goes through a swoon and it bounces back up over 30 and maybe over 50. But other than that, I don't use it at all to say this is the top in the market because it can go lower. We are, as I've been saying for a long time, I think we are late in a long cycle, a bull market cycle that started back in 1982. So this is the 43rd year as of August of a bull market cycle that I think is coming to an end. I expect to see, well, we probably could top out by the end of this year or sooner. But we've got, I raised targets back in April when we had Liberation Day and everybody got bearish. I raised my target to 8,000 on the S&P. From there, in my July investment letter, I raised my target to 8,700 on the S&P, 30,000 on the NASDAQ, 60,000 on the Dow, and the Russell 3,400. So I obviously think there's still a lot to go here, even though I think it's going to happen pretty fast. It is late in the game. We've had a long cycle. The economy is slowing. We may, in fact, already be in recession, but at this point, the evidence is not building to something that says I'm calling for a global bust next year, as you know. But the evidence right now allows most investors to see this as a soft landing, and earnings are still intact. So basically, you've got the best of both worlds: slowing economy, what I think are going to be declining interest rates, and earnings still growing. And that's music to the ears of Wall Street. That will get all the skepticism that's built up on Wall Street. They've fought this market since 2022, all the way up. You're starting to see them begin to say, "Hey, I gotta get more aggressive because this thing has legs." People, it's not that institutions go all in or all out. They're probably not very much in cash, but they're more defensively positioned. They have been skeptical towards the market. You're right. The retail investor, surprisingly, when we had that swoon back in April, they stayed in the market pretty much, and said this is a buying opportunity. It was the institutions that jumped on the bear market bandwagon and said, "Oh, we're going lower. We're going a lot lower." Strategists across Wall Street were lowering numbers and talking about 4,000 or 3,000 on the S&P. And it was surprising to see the retail investor stay basically on board and bought down there. Like I said, at the very bottom of the sell-off in April, I raised my targets while everybody else was lowering their targets. So, kudos to the retail investor that they this time were the smart money, and it was the institutions that weren't so smart.
Both gold and silver are showing powerful momentum, supported by central bank demand, a weakening dollar, and shifting global policies. While sharp corrections are possible if gold peaks around $4,000 to $4,500 and silver near $75, the long-term outlook remains extremely bullish, with forecasts of historic highs by the early 2030s. At the same time, equities may still have room to climb, even late in the cycle, as falling interest rates and resilient earnings continue to provide fuel. If a sharp correction does occur, would it present a buying opportunity for long-term investors or a warning sign of deeper risks? How much influence will central bank gold buying have in preventing deeper pullbacks in the years ahead? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.
In 2025, Arcadia Economics' Chris Marcus notes the silver market faces structural shifts amid rising deficits. Silver has surged 88% since early 2024, climbing above $40 for only the third time in history, according to a report by Arcadia Economics. Industrial demand reached a record 680.5 million ounces in 2024, while retail selling and supply constraints highlight growing imbalances. Institutional flows, new technologies such as Samsung's silver heavy batteries, and fresh central bank interest in Russia, coming from Russia, Saudi Arabia, and the US. I wouldn't say that we're central bank buying yet, but central authorities are buying silver now. We're going to be hoarding silver now. They all suggest silver's strategic role is expanding rapidly.
As deficits widen, significant structural shifts in the silver market have been noted. Silver has risen 88% since the beginning of 2024 and is now above $40 for just the third time. In 2024, industrial utilization reached a record 680.5 million ounces, propelled by innovations such as Samsung's silver-rich batteries. Although there are obvious mismatches in retail sales and supply, institutional inflows and escalating interest from Russian, Saudi, and American authorities indicate that silver's strategic significance is rapidly increasing. Vince Lancy, a veteran trader, metals analyst, and founder of Echo Bay Partners, highlights an extensive analysis of silver's prospects for 2025 published by Chris Marcus of Arcadia Economics, highlighting the metal's significance for years to come. Samsung's silver-heavy batteries are a major emphasis. The estimated demand for silver is so high that a logarithmic chart is needed to explain it. Marcus's enthusiasm and thorough analysis are evident in the report, which is a great tool for anyone interested in silver. The focus is now on Trump's new Executive Order 232, which raises concerns about the future of policy because it noticeably ignored silver despite previous references. Powell has essentially deprioritized rigorous inflation targeting, so rate cuts are more dependent on job losses than inflation, even though upcoming data like the CPI and PPI may influence markets. As we begin the video, don't forget to hit the bell button and subscribe so you don't miss any updates. Please leave a comment below and give us a thumbs up if you found the article interesting. We appreciate your feedback.
Silver's future looks very bright, as well as the unlock post, which is linked in there for Chris Marcus's Arcadia Economics. So, personal professional comment now. Chris Marcus published a mammoth, ambitious report this weekend on silver's outlook for the rest of 2025. While the report covers that time frame, makes it like a timepiece, its implications extend far beyond that, making this a must-read for anyone who wants to understand the likely path of silver ahead. One section worth highlighting is on the Samsung batteries. Now, we had read this and we know about this, but we had never looked at the side-by-side how much silver was used, how much silver could be used. We even tried to create a graphic for it, but couldn't make it fit. That's how earth-shatteringly large silver's role would be in these new batteries. We put the graphic in. The first graphic was, this is how much silver is used versus this is how much silver will be used. And it was ridiculous. So I had to make a log normal chart. And even then, it's ridiculous. Anyway, Chris was kind enough in the credits to thank me for my contributions. And I'm glad to have played even a small role in what is clearly a labor of love. If you know Chris, you know his passion for silver, combine that passion with detailed industrial analysis, and the result is pretty impressive. The full report is included in the post, and we would recommend you visit Arcadia to take a look at that as well. Moving on. Related post, HeartNet, we mentioned that. Sunday CFTC analysis, that was a really good one. It was a fun one for me too. I got 2 hours of that recorded, and very lively interaction, as well as some good questions. And plus the guys got me to talk more about my childhood trading. Mini pod, macro discretionary, Goldman, gold price near 5,000 and Fed damage. It's starting to look more realistic to me than it sounds. Coming soon tomorrow, probably, we're going to have a breakdown and analysis of Trump's executive order 232 signed this weekend. We have a couple calls into people that we're trying to get some more information back on. We understand the implications for gold. People have been talking about it. We actually have some analysis from a Goldman trading desk, institutional stuff, that'll break down the gold for us. We're going to look at that a little bit closer today. And what we're focusing on now is getting data on what was not said about silver. Silver was not mentioned. And you could say, oh, well, this is, who cares, right? No, silver was mentioned when 232 was first discussed, but it wasn't mentioned in the signing of the executive order. So what does that tell you? I don't know. We're going to find out. Data on deck, CPI and PPI. Now, those are important numbers. They're always important numbers, and they're going to move the market. But I'm telling you, they're not important unless they're incredibly high for Powell's decision to cut. Okay? The decision to cut is based on the economics. Are we firing people or not? Not the inflation. He has already raised the inflation target by abandoning the FAIT. He has basically said, I can't focus on inflation anymore. He blamed it on the FAIT, tied it to the goat, released it into the desert. The scapegoat is out there. It's done.
Vince Lancy clarifies that unless inflation is exceptionally high, Powell's rate cut plans are unaffected by short-term movements in gold based on CPI or PPI data. Intraday charts and stringent risk management, setting tight stops, taking partial profits, and letting the remainder run if momentum holds, are their main tools for trading. At the moment, silver provides little clarity but may be creating a bull flag, while gold appears bullish above critical levels. Instead of chasing moves, the emphasis is on risk management and discipline. Let's dive into the interview.
Because look, if you see gold drop $100 on CPI or PPI, check in. Why? It's not going to change his plans unless it's ridiculously high. All right, let's move to the markets. As I said, you don't want to buy gold now because of this symbol. If you're buying gold, you're buying it for a completely different reason. Okay? And I'll tell you what the reason is for me. The reason is I'll take this analysis, this system that I use, and I'll break it into an hourly chart. And I'll say my bias is bullish because of this chart. And then I'll put it into an hourly chart and I'll look for an entry point that tells me acceleration is due. That's the weekly in gold, weekly in silver. Weekly in silver's marching along. The daily in silver really was the cue there. Let me go to a couple other systems. Okay, so I'm doing my intraday analysis right now, right here for you. There's an algo buying the market. It's not safe to buy it below 36.13 for the next 2 hours. So I'm long. I'm not buying it right now, but I'm long right here, and I'll sell it on a stop loss below 36.13. And how much am I risking? $5. I'll sell it at 36.28. That's it. Risk 5 to make 10. Go with the flow. Stop yourself out and move on. Now, if the market gets down here and breaks this, I back off. I reset. As long as it's above these lines, that's poly market, by the way. Poly trends, not poly market. Poly market's the gambling site. I think these lines are pretty important for the day. And even if they weren't here, I'll take it out so you can see it a little bit more visually. This is a line going. This is a typical line that I would draw. I was like, all right, this is where it paused. This is where it got rejected. This is where it broke through. As long as it holds in this area here, 35.98 area, then I would look for another reason to get long. If it breaks 35.98, I start looking for reasons to get short. Intraday, okay? So if this never breaks, so I just bought it right here, right? In our hypothetical, I bought it right here. And I don't get stopped at and it goes to 35.28. Should I take my profit to 36.28? Well, yes, I risked 1 to make 2, right? No, I'm not going to do that today because I'm already very bias bullish. I'll sell half. I'll let the half run for the rest of the day, for the rest of the week, for the rest of the month if I have to. And that's the idea. You get a good entry, you put a tight stop in, and you trail your stop higher. That's the way to look at it. Let's see what silver offers. It's not rocket science. It's just being disciplined with your risk. Silver offers me no insight right now. No insight, at least on these things that I look at. Let's see what Poly has. I'm doing this for the chat, guys. I know you guys are very looking at this very much. All right, so Polly gives us a level to not be bullish above for the rest of the day. 41.18, which is pretty close. So no Bollinger Band analysis here. You ready? You buy it here with 41.18 as your stop. If it goes below 41.18, you're neutral. If it goes below 40.91, you're bearish. The rest of the day, intraday stuff. This doesn't affect my silver physical. Doesn't affect anything. I'm just trading. It's, how's the movie go? It's just money, right? And silver's not just money. Silver daily, that's great. All right, so this is shaping up like a I can't believe I'm saying this. This is shaping up like a bull flag.
Silver's role as a strategic asset is rapidly expanding, supported by record industrial demand, new technologies, and growing institutional interest, even as policy signals remain uncertain. Gold continues to show strength, while silver may be setting up for its next move. For investors, the key lies not in chasing short-term swings but in understanding the bigger structural shifts and managing risk with discipline. How might Trump's Executive Order 232 affect silver's future role if it continues to be excluded from policy discussions? Could Samsung's silver-heavy battery technology accelerate silver shortages faster than markets expect? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.
Like, I personally have a price target on gold up near 15,000. Not tomorrow, not this year, but in the the fullness of time over the course of this bull market. $15,000 price projection is simply an average of the previous two bull markets, the one in 1970 through 1980, and then you call it 1999, 2000 through 2011. If you average the returns in gold through those two bull markets, that gives you about a $15,000 target. We're susceptible to a sharp pullback, that is true, but we're also, I think, the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap. Higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50.
The long-term outlook for precious metals suggests significant upside, with gold potentially reaching $15,000 over the course of this bull market based on the average gains of the previous two major cycles. While short-term pullbacks remain possible, the broader trend points higher, with silver showing strong technical support that could drive it toward the $44 to $50 range, and possibly even $75 if momentum continues. Steve Penny, a respected precious metals analyst, trader, and newsletter writer, explains that after gold first touched $3,500 in April, the forecast was for prices to move sideways with a slight upward bias for several months, allowing silver and mining stocks to catch up. That's largely what played out, with gold consolidating for about 6 months before breaking higher, while silver and miners began showing strong momentum. The key lesson here is strategy. Knowing when to buy is straightforward, but investors must also plan their exits. Bull markets are volatile, with sharp swings both ways, so deciding whether to hold through volatility, take profits, or actively trade is critical. Looking ahead, Steve Penny mentions that the dollar sits at an important support level after months of decline, which has boosted precious metals. However, an unexpected bounce in the dollar could trigger a sharp pullback in gold and silver, especially since gold is at its most overbought level on long-term charts since 1980. While the long-term outlook remains extremely bullish, with targets of $15,000 gold and $200 plus silver, caution is advised in the short term. The strategy suggested is to trim speculative mining stock positions as silver approaches $50, then keep cash ready to buy back on pullbacks. To ensure you never miss an update, don't forget to subscribe and hit the bell icon as we begin the video. We appreciate your feedback, So please leave a comment below and give us a thumbs up if you found the article interesting.
After the April peak, where we first tapped $3,500 in gold, my forecast, I believe we talked about this. I know it's been a little bit since we spoke, but I was saying, hey, I think it's very likely that we just kind of grind sideways in gold for a few months to maybe a quarter or two. And, that's not what people want to hear when it's just ripping straight up and stocks are going down. We want to hear to the move. Well, that was back in April. Well, April, May, June, July, August, now we're into September. So 6 months almost of just kind of sideways. And now we're finally breaking out. But my forecast was that gold would just kind of trend sideways to maybe with an upward bias. And that would allow silver and the mining stocks to play rapid catch up. And we're beginning to see that. That's finally coming to fruition. Now, as I share a couple of charts here, I just want a key takeaway from this interview is for people to think about your strategy. Knowing when to buy is fairly easy. It's when everyone hates it. But, everyone needs to have a personalized exit strategy of, are you going to just sit through the wild volatility? Are you going to take profits? Are you going to trade around your mining stocks? These are important things to think about, especially as things begin to move, because these bull markets are incredibly volatile. And we're seeing the volatility to the upside now. And surely as night follows day, there will be volatility to the downside as well. So the question is, do you want to sit through that? And here's kind of a basic roadmap I have. Now, I think any roadmap should be taken with a grain of salt because no one knows the future, right? But one thing charts help us to do is, make if-then statements and have a roadmap. And then we adapt as new information comes in. And when I look here at this long-term chart for the US dollar, what I see since 2008 is a gently rising uptrend. And where are we at right now? We're right at the lower rail of that uptrend channel. And of course, the dollar has been declining for several months now, for a while, and that's been a tailwind to hard assets, namely precious metals, silver and gold. Well, I think what a lot of people maybe aren't expecting is for a pop in the dollar, an unexpected pop in the dollar, and that could result in a sharp pullback in the precious metals. I mean, we've come really far, really fast. Gold on the monthly chart is now the most overbought it's been on the RSI since 1980. It's the second highest overbought condition ever. That doesn't mean it can't go higher. And I'm not saying that. You're talking to someone who's probably as bullish as you can possibly be. I just told you I think gold's going to 15,000. I think that's fairly conservative. Silver, $200-$300 or more. But at the same time, over the short term here, I think caution is warranted. So I'm certainly wouldn't be chasing, gold and silver here. But you can see on this dollar chart, we followed the roadmap so far. I drew this potential path a while ago, and we've declined. Well, now here we're sitting right at the lower rail of the support. I could see some kind of exogenous shock causing a pop in the dollar. That just intuitive reactionary flight to safety, perceived safety, because you and I both know, the dollar should not, be a safe haven, but that's the knee-jerk reaction when panics happen. So I think that could happen. That could see a pullback in precious metals, and how you want to trade around that is obviously for you to decide. But for me personally, I plan to take a little bit off the table in my speculative mining stock positions as we move up towards 50, if that does indeed happen in silver, and then have cash available to scale back in on any kind of pullback.
Steve Penny, in an interview with Liberty and Finance, points out that in silver bull markets, most of the gains often come in a short burst near the end of the cycle. While silver could face pullbacks, the technical setup suggests prices are headed toward the $1.44. That may be a good point for traders to take some profits in paper positions like mining stocks, while physical silver remains a long-term insurance policy. For gold, prices are already in a zone where trimming speculative exposure could make sense, as miners like GDX show extreme overbought signals despite gold being far higher than in past cycles. At the macro level, Steve Penny thinks that the Fed is under immense pressure as soaring debt makes interest payments unsustainable. Historically, governments always choose to debase their currency rather than default, and the U.S. is no exception. With markets expecting a rate cut soon, the real test will be the long end of the yield curve. If long-term rates rise even as the Fed cuts, it would show a loss of control, likely forcing extreme measures such as yield curve control. That scenario would accelerate the bull market in precious metals, fueling even stronger gains ahead. Let's get the interview started now.
90% of the move in silver bull markets happens in the last 10% of the time. And, that may not be exactly numerically correct, but conceptually, I believe it is, where you get the biggest moves in the last part, of bull market. I'm not saying the bull market is over, but my point is, right now, we're susceptible to a sharp pullback. That is true, but we're also, I think the path of least resistance is higher, up towards 50. And this chart here, this long-term monthly log scale chart, is kind of my roadmap for, hitting higher targets near 50 and even near 75 on this move. So, silver is respecting the technicals. Right here, there's this trim profits line. So for me personally, if and when we get up to there, which coincides with somewhere between 44 and 50. So the short answer is I think we're probably headed somewhere between 44 and 50, maybe a little bit higher. But I think that could present an opportunity to take just a little bit off the table in speculative positions. Now, I just want to give a caveat. When I say that, I'm talking about paper positions. I'm not talking about going to sell your physical. To me, I view physical as a generational insurance policy against these out-of-control central planners. I don't trade that. I'm talking about if you're into mining stocks, if you're into paper trading vehicles, that could be a time to take a little bit off the table between 44 and 50 in silver. That's kind of what I'm looking to do myself.
And as for gold here, do you have any price targets of where maybe taking at least some paper profits off the table would be a good option?
Yeah, so I think in gold, we're probably already in that territory. So one of the cool things probably isn't the best way to put it, but one thing about when you're in new all-time high territory, a lot of people think that's bearish. Oh, you're overbought and it's all-time highs. Well, that's actually can be bullish as there's now no overhead resistance. But you can use kind of like price projections and measured move targets. And my measured move target for this year was about 3,500. So we've already exceeded that. So I think this could be right around in here between 3,500 and 4,000. If you're in big gold miners, like you can look at a chart of GDX and that would probably be a good one to pull up. But like on the chart for GDX, we're getting extreme overbought and we're closing in within, spitting distance of the all-time high resistance at GDX. Now you can make a case, last time GDX was at this level, gold was $1,900 back in 2011. And here we are, $3,600 gold, and GDX is just getting back to that same level. So you can make a case that it slices right through it like a hot knife through butter. However, just from a purely technical perspective, we're getting overbought here, right now in the big gold miners. And before I moved on, I did want to just share this chart for GDX. This is that long-term monthly chart. And you can see, look at this RSI right here on the top right of the screen. I'm hovering over it for anyone watching on YouTube. The monthly RSI is at 80. That's the highest ever on record. Not like an immediate sell signal, but it's a caution signal. Kind of be aware of that. And as a general rule, when you get extreme overbought against clear, obvious resistance, typically you don't punch straight through it. So big gold miners, that just reinforces the case to maybe take a little bit off the table before, I think we're ultimately going much higher. So it's up to, individuals if they want to just sit through that volatility or, kind of use volatility to your advantage. I look at like the drama going on between the Fed and the president as kind of theatrics and a sideshow. It just highlights what you and I have known for a very long time, and that's TINA. There is no alternative. The Fed is between a rock and a hard place where they have to choose between sacrificing the dollar or sacrificing the economy. And history is replete with examples where central planners, those in power, always choose to debase the currency as opposed to default honestly. The federal government's in a situation, by the way, this is all governments around the world, every single one, 100% of them, are in a situation where the debt is mathematically unrepayable. So they can choose to either debase the currency or, default, honestly, and they never choose to default. So they're going to debase the currency, and that is just explanation for why there's such pressure on the Fed to lower interest rates and, make more easy money to try and kick the can down the road. Because the biggest variable, we're heading to a point, and this is something I think everyone should understand, we're heading to a point where 100% of our tax dollars, 100% go to just service interest on the debt. That's the trajectory we're on. And the biggest variable in that equation of how to kick the can down the road is lowering interest rates. So, no one wants this, currency crisis to happen on their watch. So how do you kick the can? Lower interest rates. And that explains why there's such pressure on the Fed. And I will throw something out there. The futures markets are pricing in like a 90% probability that the Fed will cut rates on September 17th, just a couple weeks from now. The thing to watch is, and I'm not predicting this, but it's something to watch, is the long end of the curve. Watch the 10-year and the 30-year and see if, as the Fed cuts rates, if rates actually go up. That would be an early warning sign that perhaps the Fed is losing control. If they're cutting rates and then the long end of the curve interest rates rise, that would indicate they're losing control, and that would indicate that they're going to need to apply even more dramatic measures like yield curve control, which when that happens is just going to be like pouring gasoline on the bull market in precious metals.
Gold and silver remain in powerful long-term bull markets, with potential for historic gains driven by currency debasement, debt pressures, and shifting global demand. While short-term volatility and pullbacks are inevitable, the broader outlook strongly favors higher prices, making precious metals both a strategic investment and a form of financial insurance. Do you think the Fed will be forced into yield curve control sooner rather than later? At what price level would you personally consider taking profits on silver or gold? We'd love to hear your opinions, so please leave them in the space provided below. If this video was useful to you, please give it a thumbs up and remember to subscribe for more. Thank you for being a part of our journey.